Welcome to this session on multi-asset funds, multifarious or nefarious. A very interesting title indeed, given that the ultimate multifarious investment vehicles remain the multi-asset funds. Whether it is to reduce risk or increase exposure to risky assets, we will examine the pitfalls in doing so and look at some of the data that we've crunched for you to that effect. The impact of including new age digital assets in portfolios will also be analyzed. And these might enhance returns, but also have a negative impact in terms of risk on your portfolio. I'd like to thank Sage Dyer for the brilliant cartoon that you see here right at the beginning. So let's talk about the whole theme of being multifarious or multifaceted. First, let's start with a quiz. Do you recognize this pop idol? Maybe you should, if you have teenage siblings that I do, they might be more familiar with him. I went to his concert in Cape Town. I had to sort out my eardrums afterwards, given the shrieks by teenage fans. And my boy, who wanted to go and watch his own idol, fell asleep halfway through. If you still don't know who he is, let me give you a hint. He had one of the most viewed videos on YouTube and also the most disliked video for the same hit. That was his biggest hit. This is no other than Justin Bieber. As you can see, even in the pop world, you can have multifarious or even nefarious characters lurking. But let's talk about long-term wealth creation. If you look at risky assets on the JSE, we constructed an index based on risky assets onshore and offshore and compared them to safer asset classes. You can see on an annual basis, you remain exposed to quite large drawdowns. And the upside return capture from equities over the safe asset classes are not always obvious. But as you extend your investment horizon, looking here at 3 years, you can see a clear differential and superiority of equities over safe asset classes. There are two instances which you can pick up on the chart on the right, that where things don't look as good for equities, even though you might have a 3-year waiting period or holding period. That's at the end when the period ends into the global financial crisis and more recently into the COVID crisis. Let's extend the investment horizon for 5 years now. Over 5-year holding periods, you can see that returns are fairly strong and positive, and there's quite a large differential between risky assets and safe assets. Except for the 5 years, 5 odd years ending into the global COVID crisis. There you see returns from equities and bonds being fairly equal. So the one lesson here is the longer your horizon or holding period going in over 3 years, the less concern you have about drawdowns when including equities or risky assets into a multi-asset portfolio. And the key quote for me is one from Warren Buffett. The stock market is a device for transferring money from the impatient to the patient. And the main pitfall for many investors is that they want profits fast. Now, we extended this analysis to global asset classes. This is the work from the data analysis team at Ashburton, headed by Matthew John. There, offshore, we have access to much longer time series, starting from 1860. On average, if you look at the charts on the left, you can see that whether it's held on average for 1 year, 3 year, 10 year, or 20 years, equities have delivered much better returns, about 5 or 6% per annum more than bonds. However, this doesn't take into account, these nominal returns don't take into account risk. Once you adjust for risk, or volatility of returns, you can see if you invest in equities with a 1-year horizon, on average, you would end up worse off being in US equities than in US bonds. But as you extend this holding period for longer than 3 years and longer, the equity risk premium starts to reestablish itself. And you can expect, on average, over very long periods of time, about 4 to 5% more from equities compared to holding bonds. So that's the good news. And that conclusion that we had for the JSE also applies globally. But now, what are the risks and what are the issues here when we look at statistics? Firstly, let's talk about one of the main behavioral problems for investors. This is a very recent YouGov poll done in the UK, asking a sample of men and women whether they could beat these various animals in a kind of fist fight. Interestingly enough, talking about overconfidence, about 7 to 9% of men interviewed said they could beat a grizzly bear or a lion or an elephant with their bare hands. So that's clear overconfidence. On the other extreme, when you take the impact of fear, and that might surprise you, 25 to 30% of men and even more women don't think that they would be able to win a fight with a rat, a cat, or goose. So you have these two extremes when you look at human nature: overconfidence and also delusions, and a complete excess fear when faced with danger. So how does that translate into markets? Let's go back to what we were talking about earlier in terms of the equity risk premium. That's the data in the US over 10 years from 2010 to 2020, very clear superiority of returns in terms of the equity risk premium if you invest in equities versus bonds. But if you got the period wrong, if you went into equities at the peak of the dot-com bubble and panicked at the bottom of the global financial crisis, so going in 2000, getting out in 2009, being in equities, even though it was for a 9-year period, you would have earned a negative 5% return per annum over that 9-year period, whereas bonds would have given you 7% per annum. So they're bonds superior to equities just because your entry point and exit point were wrong. Similarly, we did this analysis looking at a 14-year period, getting in 2006, but then exiting at the bottom of the COVID crisis recently last year, in March last year. There, the differential in returns would be negligible between equities and bonds, and obviously you would have been better off if that was your exit point to have been on a risk-adjusted basis in bonds. Extend that by a year, just looking at what returns would be over 14 years, almost 15 years, from 2006 to last month, April 2021, you would have earned 10% per annum in equities as opposed to 4% in global bonds or US bonds. So you can see here that even though we said earlier that a long holding period, long horizon does help cushion the impact of volatility, getting in at the wrong time and exiting definitely in a bear market or at the bottom of a crisis will cost you in terms of investment return. So beware the potholes. So investments have their nefarious side. While it will be your friend to grow your wealth long term, it then also can destroy capital with the wrong behavior. And the real enemy here are these sharp bear markets and sharp drawdowns. I've just aggregated here 5 periods in history which have been the worst drawdowns in terms of equities and bonds. And you can see that your wealth can halve in a bear market, almost half, down 40% to 30, 40%. And the point here, and it's important for trustees and advisors to make sure that investors do not cash in or panic in these times. We need to have the patience to either realize one's gains over time and to make sure that we're guided by valuation in terms of where we decide to move from risky assets into safer type of asset classes. Unfortunately, that type of behavior and patience doesn't exist right now. I just wanted to show on the left the holding periods of 4 stocks on the New York Stock Exchange. You can see that in the past, the average holding period was 5 to 8 years for stocks, but now that has declined to a few months. And really a big factor, and I use the characters here, Bobby Axelrod from the series Billions on Netflix. Hedge funds have created this very short-term behavior, and we're seeing also in terms for a lot of retail investors, it's been really the Robin Hood generation trying to make a quick buck, which is very unfortunate. So to quote Sir John Templeton, I think it's very important to pass on a message. Timing the market is more important than timing the market. So what's driving market at the moment? The main force behind markets has been the central bank monetary expansion. And you see on the chart at the bottom that global equities have flirted with record level, really driven by the expansion in the monetary base. So how do we deal with these extreme cycles in our own asset allocation framework at Ashburton? A year ago, the world was in despair. There was a bear market. Everything looked very red and hopeless. As economies started to reopen, prices started to rise strongly. There was hope that economies would start to recover, and then we got into a lot of growth revisions. And in some cases, in some aspects of the market, we're seeing right now exuberance, which is very dangerous. So we use this framework to guide how we make investment decisions. But we need to remain careful of the nefarious side of the market. If we look at this chart, which shows you fragility events or global equity sell-off since the 1930s, there's been one such sell-off per decade since the 1930s. And yet from the GFC, we've seen 5 of those per decade. And any sign of tapering by the Fed or any other global central bank seems to lead to one of those. So equities, while the best asset class to grow wealth, can also be the ones most exposed to black swans. And forecasting these black swans or sell-off event periods are quite difficult. I use here an article from Queen Elizabeth, who addressed my alma mater, the London School of Economics, after the global financial crisis, asking how come no economist was able to forecast the GFC. Bottom right, an article showing that most official government economists and private economists seem to miss both global booms and recession. And the top favorite quote of mine, which I picked up recently, is one which says inflation which is a big issue now in terms of global investing, may be transient, but may also be longer than we expect. So tail I win, head you lose. Up to now, if you look at 5-year returns prior to the COVID crisis, the place to be in the South African markets has been in income funds, money market, and global equities. SA equities return very low returns for additional risk. Is that still the case? Global interest rates, if you take this chart from 3,000 years BC to now, are at record historic lows in nominal terms, although they've started to turn globally. South African interest rates, if you look at where we are now at 50-year lows, with the SARB going from being very, very hawkish to very dovish. So interest rates are low in South Africa and low but rising globally. And yet we've seen record flows, despite its low rates, into cash funds last year into money market and income funds, and the same globally. So with the investor universe being risk averse, people have been putting their money into cash. So this extreme fear described earlier. And unfortunately, this has cost in terms of returns. SA equities have offered double the returns of global equities. And the money market rates have been just about in line with inflation. So the worst place for the retail money to be. So what else are investors looking at? Obviously, Bitcoin and cryptocurrencies is the one big area of discussions that we found in terms of our investor base. Let's talk a little bit more about this. Intangible asset, digital assets. 90% of the market cap of the S&P 500 is now made up of intangibles. Interesting. The rise in price in Bitcoin really has correlated by the growing volume of sovereign bond debt, which is negatively yielding. So money has found its way elsewhere when traditional safe assets haven't offered the yields expected. And beyond that, we've seen new ETFs being launched, which invest in what they call digital transformation companies like Square, Taiwan Semiconductors, PayPal. And unfortunately, some of these new launches, we've seen some this year, have yielded negative returns for investors. So just because it's popular doesn't mean it's a good investment, unfortunately. And we also have seen that many investors now turn to a lot of conspiracies and blogs to inform themselves. If you look at the recent coronavirus crisis, the conspiracies blame Bill Gates or 5G for the virus and the pandemic. Obviously wrong. And the way people get news in terms of social media influences how they invest. Rather than going to an expert or financial advisor, now their phone or smartphone or blogs is what people listen to or follow. And yet the more traditional, the gray hair, if you take Warren Buffett and Charlie Munger at the last Berkshire AGM, have really highlighted Bitcoin as what they call disgusting and a really nefarious asset class because it's used for ransomware and for a lot of illegal activity. That said, what was interesting on the day they made this comment, the Nasdaq was not able to record a new high in the Berkshire Hathaway share price because that share has just been climbing for decades now. So let's talk a little bit about crypto. More recently, Elon Musk, who was a big supporter and had been buying Bitcoin in Tesla, decided to suspend the purchase of vehicles using Bitcoin. He blamed cryptocurrency as not being ESG friendly and really not good for in terms of its carbon footprint. So talking about ESG, did you know that Bitcoin consumes more electricity than the Netherlands, than Argentina or small Scandinavian country? And a lot of it is dirty energy because a lot of Bitcoin mining happens in China. So ESG is a key investment precept now for our investors. This is an advert on Black Friday from a company called Patagonia, which actually said, do not buy our jacket because the best way to reduce the carbon footprint is to consume less. And you know what happened? Actually, sales in this company has boomed. They even got very political at the last US presidential elections by having labels on their clothing asking to vote the incumbents out. So ESG is a big driver now of success in our markets, and we consider those when making our own investments. So the new face of global assets, you might think, cryptos, $2.2 trillion. But ask yourself this question, would you rather have 6% of all the companies in the S&P or or the whole crypto asset class, or 20% in all the gold mine in the world, or own all the cryptocurrency in the world. I know what I would choose. So to make it even more interesting, let's compare digital assets to real assets. Lumber's done very well, gone up more than 100% given the work from home and spent on housing globally. But that is nothing when you compare to what Bitcoin has done in yellow. And yet, if you compare Bitcoin to Tesla or rhodium, which is used in catalytic converters, Bitcoin has lagged. So in terms of speculative asset, Bitcoin's done really well, but there are other asset classes, or investments which have done better. And I would warn here that Michael Burry of the Big Short decided to recently, and that's a month ago, short Tesla substantially. So just because it's popular doesn't mean that it's the right place to invest. So is it worth the risk? As we come to the end of our conclusion. There's no shortcuts. You need time in the market. Yes, there are new nefarious ways to get rich, but speculation can be very risky. You may make a lot of money or lose a lot of money. You've seen that recently with Bitcoin whipsawing down 30% in the morning, only to be up 30% in the afternoon. If you look at this chart, with an average over 3 years of 80% per annum, you can see 80% return is in line with the risk that Bitcoin offers you. And other potential investments like rhodium and Tesla seems to even have a better risk return type of trade-off, and yet they are equally as risky. So it's always caveat emptor. When faced with new ways of making money, ask yourself, is this time really different? Are you buying assets with predictable cash flows? Are you following the advice of some nefarious blog who are more likely to lose you money than make money? If you are unsure, our team at Ashburton Investments are here to help you. Thanks for listening. After the break, Albert Botha, Head of Fixed Income, and Cornelio Kiwi, Head of Credit Investment, will share their insights on the use of fixed income investments in a low rate world.